Good afternoon, everyone. My name is Colin Day. I'm a financial advisor with Correct Capital Wealth Management, and you are attending our quarterly financial wellness webinar. Today's subject is demystifying investments in your 401k. And we just ran into this interesting article, which I'll show in just a moment. Some of the findings out there made me a little fearful as a financial advisor in terms of, what we're trying to do is to make sure you all are empowered to make great decisions as it comes to, at least for this particular presentation, your 401k plan, because some of the things that scare people the most when it comes to addressing their 401k has to do with the investment side. And so what we're going to talk a little bit about today is about the investments so that you feel, well, more knowledgeable, hopefully. You feel better educated as you approach making decisions on your investments, so you know a little bit more, and we can bridge the gap, so to speak, so that when you want to make a change to your investments, you have a little bit more of an idea as to what you're approaching and how to make some changes on your own. But knowing, of course, that we're here in case you do have any questions for us. So here's that article that I was telling you about. So this is an industry publication called Pensions and Investments, and this particular article, again, put a lot of fear into me to think like, oh, shoot, am I doing my job as well as I could as a 401k advisor to make sure my participants are empowered to make decisions on their own? 401k participants don't understand target date funds or managed accounts from a Cerulli report. We use Cerulli quite a lot as it comes to making a lot of decisions, or at least informing us as advisors on what our participants need or what the industry is saying about us. So if you're not familiar with a target date fund or a managed account, we're going to talk a little bit about both of those things today. Again, but you'd be a part of the statistics then that as of at least this print, 67% of the respondents were either not sure or selected the wrong definition of two investment products. So they're basically given two options of saying like, hey, which one is right for which one, and they were guessing wrong or not sure. So 21% of the time mistakenly misidentified the objective of a target date fund. What was most alarming about that is that this is the most common default investment in a 401k plan. So if you were ever to leave your employer and go start up a new 401k, if you haven't had to do that in a while, more than likely, they're just going to default you into a target date option. And so to not know what a target date fund is, to just understand the most basic definition of what it is very alarming for us. So that's a part of what we're going to talk about today. Also, 50% of participants identified the ability to speak with a human advisor as one of the top two most valuable aspects of financial advice. Again, that's why we're doing this. And you might not be getting direct advice today, but after this meeting, if you have questions for me, I'm more than happy to address them so that, again, you have all the information that you need, or at least most of the information, to make an informed decision on your own. Now, we're going to use an avatar, and his name is Ali. He's 34 years old. He's got a new job, so he's newly eligible for a 401k plan through work. So we're going to live a little bit through Ali's experience of maybe not being completely informed on 401k plan. Maybe he's never had a 401k plan in his life, but we're going to use him as the example for how he is going to develop, hopefully, and become more informed on making investment decisions. So first, he's going to start off pretty confused. He's trying to focus on his finances. So again, in his stage of his life and in his career, maybe he's got some stuff together, maybe he needs to figure out some things. And maybe the 401k plan is an area where he says, you know what, this is something I need to concentrate on. Normally, as we approach our 30s into our 40s, the dollars in our 401k plans start to get larger. Maybe we've crossed from 4 into 5-figure accounts, maybe even to 6-figure accounts at this point, if we're lucky. And if that's the case, then well, this money is really real. This really means something now. We want to make sure that we're as well informed about it as possible. And specifically, he wants to know about his investment options, because if you look at your 401k plan, if you open up your app or if you go on your website and you see all the various investment options, you'll notice that there's lots of different flavors. And it's not just chocolate and vanilla out there. It's a little bit of everything. Butterscotch and cookie dough and sherbet and all the other stuff. And then all the other weird desserts that you might have. You might have pie next to the cake, which is next to the ice cream. So we want to make sure that if he's interested in understanding investments, let's make this digestible. I know I just talked about ice cream, and well, saying it's digestible is kind of funny to me, but for all these purposes, we're trying to make them comfortable and better informed. So first of all, what investments are a part of a 401k? Now, the most often found investment in a 401k plan are mutual funds. So I put a definition there. It's a pool of money for many investors to buy diversified portfolios, stocks and bonds, or other securities, depending on the objective. And that's the important part, is that a mutual fund has some kind of objective. It is some kind of stated paragraph or multiple paragraphs in the prospectus that says this is what this fund is all about. Not all mutual funds are created equal. Some of them are going to focus maybe on the companies that you see on the page. Maybe they are going to be bonds. Maybe they want to focus on something more specific. For example, like they want to focus on a particular investment scheme of some sort. Maybe they want to focus on cryptocurrency or something like that. Bad example with mutual funds, but I think you understand the picture. We have to be focusing on some kind of objective here. Now, a professional money manager is going to be the one that actually chooses the underlying securities for the mutual fund. So as the mutual fund professional, this manager, that portfolio manager's job is to populate the mutual fund to spread this out amongst a lot of people. How I explain mutual funds is like insurance. Many insurance companies are mutual companies. State Farm comes to mind. So it's all these people that have insurance through this one company that is spreading out the risk amongst the tens or hundreds or millions of people that work with that particular insurer. So that when one person has a claim, they're in an auto accident, as an example, you're spreading the risk out. That one person suddenly doesn't become uninsurable because there's a whole bunch of other people that are paying the bills. So the person that suffers the loss doesn't mean that it's going to wreck the whole insurance industry, because the risk is spread out amongst multiple people. That's really what a mutual fund is. So it's spreading out the risk, and then it's choosing an objective for that kind of risk that we're using. Now, an exchange traded fund is similar to a mutual fund in that there's lots of different companies and that there's going to be an objective. However, ETFs are going to trade on a stock exchange. So they trade intraday. So meaning that with a mutual fund, and I think I mentioned this later, but I'll mention it now, a mutual fund trades at business close only. So if I made a change right now, it is currently 1:12 p.m. I won't actually have any trading done on a mutual fund until the end of day. So however the market settles on the end of the day, that's my result. Whereas with an exchange traded fund, these types of buys and sells happen throughout the day. Now, they also offer diversification and can be flexible and cost effective. And then part of their low cost is that a good number of ETFs focus on a market index. So what I mean by that is that's the S&P 500, that's the Russell 2000, that's the MSCI. There's all these various indexes that just track different kinds of objectives. So whether it's focusing on big US companies, that'd be like the S&P 500, or the Russell 2000, which is going to be on smaller companies, et cetera, and so forth, they're all going to have an objective. And because they're just tracking a market, many ETFs that focus on index investings are lower cost options. Okay. The important thing, if you're still with me, is that these are just a different kind of flavor that may be available in your plan. Now, collective investment trusts, these are kind of the newerish flavor that are coming about more often in 401k plans. Now, if you work for like a really big employer, like Fortune 500 level, this is probably the most common thing that you see in there. You might think it's a mutual fund, but it's actually not. It might be a CIT. And a CIT are very similar to mutual funds and ETFs. Can you sense a theme here? In that they pool assets from investors. But CITs are generally only available with very high minimums. So again, if you have tens of thousands of employees, you might have a CIT available to you. Or if your plan is massive, hundreds of millions of dollars, it's more common to see the entire available options of CITs. I used to work for Nationwide. Nationwide has a lot of people that work for it, tens of thousands. There are probably billions of dollars in their 401k plan. Our entire options, as I remember it when I used to work there, were CITs. So I could not pick and choose different kinds of Vanguard or Fidelity or any other mutual fund companies, mutual funds in the portfolio. These were bespoke instruments that were created specifically for the company and is being managed by a professional manager. So again, when you get into these really big plans, if you work for a super big employer, these are very common. This is starting to come further downstream. So for smaller plans, so think like tens of millions of dollars plan size, CITs are becoming more of an option for plan advisors like ourselves to consider for you all. Now, stocks. If you're not familiar with what a stock is, that just represents ownership in a company. And some 401k plans will allow you to purchase stock of your own company that you work for and hold it in your account. This isn't as popular as it used to be because now not only is your future retirement success based on the performance of the underlying stock of the company you work for, but also your paycheck is completely dependent on you maintaining that job. So you are duly liable in this case to say like, man, I really hope I do well so that I keep my job, but I really hope this company does well because that predicts my financial future. Okay. So other plans may offer what's called a brokerage account window. And through this window, you may have the ability to purchase outside investments, and stock might be one of those options there. That's another way that people can invest in a particular company they would like through their 401k. However, there are additional fees that come along with these types of brokerage windows because now you're opening up Pandora's box a little bit in terms of the kinds of investments that are out there. Normally, there's some kind of either annual or monthly maintenance charge, and then the plan might become just in general more expensive because you're moving more money out of the core plan into a separate window. Now, let's check on Ali. How's he doing? Oh, he's angry. Okay, Ali, settle down. We're okay. Let's make this easier for him because there was a lot of information for Ali as somebody who's just trying to get his act together to understand investment. So let's make sure that we can make him more comfortable. Let's focus on mutual funds because the vast majority of you that are on this call today have mutual funds as a part of your investments. They might be the only type of investment that you have available to you, for all I know. The most common form of mutual fund is what's known as a target date fund. Like I said before, it's a default for a lot of plans to just say, hey, let's just construct a portfolio based on risk and age. That's what this is doing. So the nice thing is that it's more aggressive when you're younger and then it moves more conservative as you age. This is the type of set it and forget it type of investment that if you invested day one of employment in your 20s, let's say, and you just work for the same company for 4 years, 40 years, you put the blinders on, and you don't do anything with your 401k plan besides put money into it, well, hey, it was probably more aggressive when you were younger, which means it probably did a little bit better. And then as you got closer to retirement and you were thinking about the risk in the account, if you were thinking about risk at all, at least it was lowering the risk over time. So what that chart is showing, if you could see that, and actually here, let me go to the next page. I zoomed in. This is an example from Vanguard. So if you have Vanguard target date funds, your portfolio allocation may look like this. What you need to know on this slide is that the greenish bluish colors are referring to stock, whereas the other yellow orange colors are referring to fixed income. That would be bonds. So what you'll notice is that in the early phase, which is phase one over on the left, early career, they're saying, hey, about 90% of your money would likely be in the stock market. The other 10% would be in fixed income. Stocks are more aggressive. Bonds are generally less aggressive. As we get older in age and as we approach retirement, we start to see the percentage of money in stocks start to decrease, whereas the percentage of fixed income, bonds, starts to increase to a level that makes sense with the fact that, hey, my account is growing. I want it to still grow. I still want to participate in the market, but maybe I don't want to take the risks of a 20-year-old because now this money is a lot more real because I'm going to retire, say, in 10 years. And what you'll notice here is that there's never a time where the market risk just drops to zero, where they're not focusing at all in investments or all in bonds. There's still going to be some kind of stock portfolio attributed to this. This one in this example drops down to somewhere around 30%, illustrating the point that, hey, we still want this thing to grow in the future. We need this thing to last you for 30 plus years in retirement. So let's make sure that we're allocating correctly. So again, a target date fund just takes the amount of risk that they feel is appropriate for your age, and then it lowers the risk as you get closer to retirement. And all companies are going to be different in terms of how they do this. This is just a Vanguard example. Some might hold on to risk longer. Some might get more conservative than what's being illustrated here, for all I know. Every company is a little bit different. But just know the general guidelines. This is how a target date fund would work for you. Similarly, there's what's called a target risk portfolio. Now, target risk portfolio is going to maintain a specific risk level by balancing the different asset classes together. But then you get to match your risk tolerance to the investment. So for example, if we look over on the right, so this is just provided by another firm, they are saying, hey, here's an example. What's the risk and return depending on the portfolio allocation? If we start all the way on the right side where it says aggressive growth, that top pie chart, you'll notice that equity, so that's referring to stock, is about, let's eyeball it and say it's about 75%. Fixed income seems to be a very small portion. And then what they're going to call tactical, which might be, hey, where do we float depending on what's doing well in the market? Do we float more towards stocks? Do we float more towards bonds? You can see that that's a minority, maybe let's call it 20%. So there could be up to about 90%, let's call it in stock at any one time in that portfolio. Whereas with moderate growth, what you're going to notice is, oh, okay, well, there's a lot more bonds in that one compared to the aggressive growth. And then rinse and repeat over to the left until stock becomes the minority in the account. So a target risk just allows you to say, hey, Colin, I might be 50 years old, but I don't want to take the same risk as a 50-year-old. I want to be more aggressive, or vice versa. I want to be way more conservative. And that allows you to then fix the portfolio to the risk tolerance that you have, as opposed to it tying it to your age. Okay. So again, target date funds are most likely the investment risk that you'll be put in if you were to enroll in a brand new 401k plan, but a target risk fund is going to be one where you can play with your risk tolerance a little bit more and dial that in a little bit closer, possibly. The one rub with the target risk fund is that unlike a target date fund, target risk is going to hold on to that investment risk until you say when. So you could be super aggressive forever and not even know it unless you're checking your account. So just be careful here. Now, there are what are known as stock-focused mutual funds. So there are many different kinds of these in retirement plans. I don't have a specific example. Well, actually, I do have a couple of examples, I guess. This is a mutual fund that is primarily invested in a basket of stocks. So that's their objectives. They're looking at stocks, and then they're going to get more particular in their objective. For the example I put on the left, like large cap growth. So that's focusing on big U.S. companies and growing sectors. The two that I traditionally talk about would be like tech and healthcare as an example. Now, they offer higher growth potential, but of course, it comes with additional risk. Their diversification among dozens, hundreds, or thousands of companies is, in theory, supposed to spread out the risk. Over on the right, this is from Capital Group, otherwise known as American Funds. That's some of their selection of different kinds of investments in the stock-focused area, but each of them have their own unique objective. So for example, you can see Euro-Pacific Growth Fund. Well, that's going to focus on Europe and the Pacific countries, if you could believe it. And it's going to focus on those types of growing industries there. Whereas if you were to go to the Growth Fund of America, same kind of concept, still looking at growth, but now we're focusing on the US. And so all these are going to work a little bit differently, but they're all going to be stock focused. Whereas if we look at bond focused examples, we're going to do the exact same thing. The objective now is just changed to bonds as opposed to stocks. Okay. And now they're going to offer likely a more stable return when compared to stock funds. So we're lowering the risk again, and bonds can vary in focus from multiple different objectives and sectors. So within the bond sector, within the debt sector, we're talking about maybe municipal or corporate or high yield securities. Maybe we only want to focus on U.S. Treasuries, something like that. And again, you can see the examples over on the right side. Each one of them is going to do something a little bit different, which then may require you to maybe double click a little bit and get more information from them. So you're saying, hey, I'm interested in U.S. Treasuries because they seem to be performing well at the time. I click on that one. I determine, okay, underneath the hood of this bond fund, this is the objective and this is what it's doing and this is what it's holding. Does that interest me or not? And if it does interest me, here's the percentage that I'm willing to put towards that particular instrument. Now, there's also a part of these retirement plans, guaranteed options. Now, I use the word guaranteed loosely here because it's hard because every plan is a little bit different in terms of the options that are available. So whether or not your plan even offers one is subjected to the plan's rules and its investment policy statement. They might be called, if you do have them in your portfolio, a fixed fund or a stable value or an annuity. Money market could also fall into this particular category. The idea here is that they provide a stated return or approximate stated return, which provides you with some peace of mind that will lower the risk and you can sleep at night. So we went from stock related funds to bonds and now to guarantees. So the most risky all the way down to the least risky options. Now, if we go back to Ali, cool. All right. Well, he's not so mad at us now. He seems to be getting it. But how can he make the right decision for him? Well, talking with an advisor. If we go back to that study by Cerulli, talking to a human advisor helps. It helps flesh out the ideas in your questions. Now, robo advisors could do maybe something similar with a questionnaire. The human touch tends to be able to read between the lines a little bit better, which is why we always encourage you to speak with an advisor about your account. So if I'm your financial advisor on your 401k plan, I'll have my email up in just a second. You can send me an email. We can find a time to chat. I'll send you my link. If you have a personal advisor, talk to them about your 401k. Again, I've been doing this for a while. It's not unlike many advisors to forget, oh, yeah, I wonder what my client is doing in their 401k plan that I can't see. You might have IRAs with them. Maybe you rolled over an old 401k with them and then went to work in another job. But unless they have some kind of connection to that account or you're regularly providing statements to them, they might not know exactly what's going on there. So they can help bring focus to the entire holistic financial picture that you have, as opposed to just thinking about the money that they have under management. Or like me, if I'm your 401k advisor, I can talk to you about your 401k because it's right in front of me. I can see the balance. I can see your investments, but I might not know what else is going on the outside and how, again, that balancing act might work. And again, I say this, the second bullet point for a particular reason. Each individual is unique, and thus your portfolio allocation must reflect what's right for you, not your coworkers. I used to work a lot with firefighters. Firefighters are very attentive when it comes to detail, especially in their retirement assets, because a lot of times if they have some time to kill and they're going to hang out on their couch or their cushy chairs for the 10 minutes they're given between calls, well, they're going to often pull up their phones and they're going to pull up their investment accounts and they're going to take a look at things and they're going to chat. So when I come to the firehouse, or when I used to, they were all having conversations about this, and they all tended to have the same conversation with me about maybe one particular security in the portfolio. The thing is that each individual is unique. Just because one person is investing in something or not investing in something doesn't necessarily mean that that means something for you, because you're unique. You might be the same age, you might be in the same job, you might have the same title for all I know, but you don't live the same life as them. Your hopes and dreams might not align exactly with the person that's on the other side of the cubicle or the person that's on your team. So that's why we always say, hey, if you have a resource like you all have through your 401k plans, if Correct Capital is your financial advisor, let's have the conversation. Let's make sure that what you're hearing is also right for you. Now, in meeting with your advisor, here are some talking points. So again, as I tell many folks, we're here for your 401k plan, but we touch everything that has to do with money. So you might come to me and just wonder how your 401k plan is going to do, but I'm probably going to ask you at least a couple of these things to make sure that what I'm talking to you about in the 401k plan actually matters. Because if you don't have an emergency fund, ooh, let's talk about that, please. I don't want you to run afoul of needing to withdraw money from your 401k because you didn't put enough money aside for yourself. Or maybe, how much you're saving in here. You might be saving 6% here, but unless I ask you, hey, are you doing anything else elsewhere? You might be maxing out your IRAs. Or maybe you have a spouse that isn't able to contribute anything and you need to increase your savings. I don't know. We have to have that conversation. The expenses that you have in the near term, which then alludes to how much money we should have in emergency fund or on the side, or when you'd like to retire, which means that, hey, your 15% that you're contributing is great, but if you want to retire at age 40 and you're 30 years old, we got to really ramp up that savings somehow. Or again, what kind of risk is right for you, which then relates a little bit more to the investment side of things. So again, these are just bullet point talking points that we would want to make sure that we address with somebody. And another way to think about this is that this is to match your risk, your time, and the personality and who you are with your investments. So I had a comment from somebody the other day that was wondering if Colin might be a fit for their personal wealth management needs, so not a part of their 401k. And so it's like, Colin, we're already fine with our investments. Why would we need to hire a financial advisor? Well, it's the fact that the investments is just one component of many different things that we have to think of. How much risk are we putting in there? Is that the right kind of risk? Is it in the right kind of accounts and places? Time, when are we going to use this money? Do we have money siloed off into various resources for us? Your personality, can you take on the level of risk? Do you come with baggage, personal baggage from how you grew up? Did you have a lot of money all the time? Did you not? Do you spend a lot or do you save a lot? What does your personality say about you? That then leads us to, the investment side. The investment side for most advisors is a very small component of the various things that we do with folks, and it takes a conversation to be able to do that. So, Ali, how did we do? Oh, thank goodness. I was really worried about the guy. When I created this presentation, I had no idea if there was going to be a stock photo of a guy with his 2 thumbs up. I found it. There's Ali. He's doing well now. All he needed was the education, direction, and a conversation to point him in the right direction. So now Ali, and hopefully you all, have more education on the types of investments that you'll see within your portfolio when you log in next to your 401k, a little bit more of a semblance of an idea of what you might do with those types of investments. And then always, in case emergency break glass, give a call to Colin, send me an email. I'm happy to discuss these types of things with you. So finally, here's the 401k team. It's myself, John, and Alexia. All of us are here to be a resource for you. If you have questions for me and you want to take them offline, shoot me an email. We'll find a time for us to chat, 15, 30 minutes, depending on what the question is. If you're more used to talking to John or Alexia, feel free to hit them up. That's perfectly fine as well.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.